This is Chapter 11, Calculating the Cost of Capital. This chapter is about the concept and the calculation of the weighted average cost of capital. We'll talk about what is the cost of capital and why do we need to estimate the cost of capital. And then we'll explain how to calculate the WACC, including how to calculate every component in the WACC formula. If you recall from Chapter 7 and 8, we talk about required rate of return by the investors, including the required rate of return by bondholders and also the required rate of return by stockholders. And these are from the investor's perspective. And here in Chapter 11, we'll think about the question from the company's perspective. So if a company needs to raise money, including raise debt or equity to finance its operations and expansions, how much does the company need to pay for the financing? Or say, what is the cost for financing for this company? Well, how much a company has to pay, that actually depends on how much investors would require as return. And as we have already learned, investors would require different return from debt, preferred stock, or common stocks because the risks involved are different. So the required rate of return will be different across the different kind of capital. Usually a company doesn't just use 100% debt or 100% equity. Instead, they would use a combination of debt and equity to fund their operations and expansions. So that's why we need to estimate the average cost of capital. So we are looking at a cost of capital as an average across the cost of debt, cost of preferred stock, and cost of common equity. But we cannot just do a simple average because the amount of debt and equity capital usually would be different in the company. So that's why we have to calculate a weighted average, and the weights will be based on the proportion of debt and equity capital used. This is the overall formula for the weighted average cost of capital. So in this capital, E is the market value of common equity, P is for the preferred stock, and D is for debt. And if we look at the IE, IP, and ID, these are for the cost of equity, cost of preferred stock, and cost of debt. So as you see, our job in this chapter is to figure out all these components like E and P and D here so that we can calculate the weights of the common equity, the weight of the preferred stock, and the weight of the debt. And then also we need to figure out the IE, IP, and ID and then put everything all together and calculate the final result of WACC as the weighted average of cost of capital. You do notice here for the debt, for the cost of debt, we have the ID multiplied by 1 minus T. If we look at the ID part, the ID is the before tax cost of debt. And if we use ID multiplied by 1 minus T, we get the after tax cost of debt. The reason that here we have the before tax and after tax cost of capital is that, as we know, interest on debt is tax deductible. The fact that interest expense is tax deductible actually can help the company save a little bit tax money. So in that sense, after tax, the actual cost for the company is lower than the interest rate the company is paying. So we want to use the after tax cost of debt to reflect the actual cost of the company borrowing money. So to find the before tax cost of debt, this is actually something we did in Chapter 7. We can try to calculate the yield to maturity, the YTM, on the company's bond. If you recall from Chapter 7, the Yield to maturity measures the debt holder's return, and is a comprehensive measure which includes both the coupon payment and the principal, or say the final par value payments. Here's an example to calculate the yield to maturity first. If we have a 20-year bond, 8% coupon rate, currently sells for 90.7% of the par, and if this is an annual coupon payment bond, then we have 20 years. Price will be $975, which is 97.5% multiplied by the par value, which would be the 1,000, which is also the final FV here. Payment is $80 per year. So then we can just compute IY, and IY turns out to be 8.26, and that is the 8.26% yield to maturity, and also 8.26% before tax cost of debt. So if we use the before tax cost of debt multiplied by 1 minus T, T is the marginal tax rate of 35.92%, then after tax, the company is actually paying 5.29%. This is the company's after-tax cost of debt. So in this example, we just calculated the ID, which is the 8.26%, and then the ID multiplied by 1 minus T part is what we have as 5.293%. So we got this part. And now let's move on to calculate the cost of preferred stock. If you recall from Chapter 8, we talk about preferred stocks, and preferred stocks, they pay preferred dividends, and the amount of preferred dividends are usually constant forever. So we try to value the preferred stock as a perpetuity. If you remember, P of the preferred stock equals to D divided by I, the dividend from the preferred stock divided by the required rate of return from the preferred stock. Then if we just rearrange that formula and assume that we have the market price for the preferred stock, and then we would have I equals to D dividend divided by P0, which is the price for the preferred stock. And we can actually use this equation to estimate the cost for the preferred stock. So imagine if the company now wants to issue preferred stocks. If the company received this much price from the preferred stock, in exchange, they promise to pay this much dividends, then for the company, the cost is estimated to be D over P every year. Again, if you remember from Chapter 8, this can be considered as a special case of the constant dividend growth model, special in that here the growth rate is 0. Now if we look at the example for estimating the cost of preferred stock, if we have this company that has a 7% preferred stock outstanding and currently trade at $72 per share, so P is 72. Usually when we say 7% preferred stock, we assume a par value for the preferred stock of $100. So 7% multiplied by 100, that's $7 per preferred stock every year as a preferred dividend. So 7 divided by 72, that is giving us a 9.72% cost of preferred stock. By issuing one stock, the company can receive $72, and as a cost, they will have to pay preferred stockholders $7 per share as dividend in the future every year. So in that sense, the cost for the company is about 9.72% every year. So this is the process to estimate the cost of preferred stock, the little IP here in this equation. So far, we've tried to deal with the cost of debt before and after tax. We try to solve for the cost of preferred stock. And the next one we want to deal with is the cost of common equity. So we'll talk about the two approaches to estimate the cost of common equity in the next video.